Welcome back. Quick commerce companies are on our radar. Over the last couple of trading sessions, there has been some, commentary around it itself. Day before yesterday, we had Ramdev Agarwal talk about how quick commerce companies may continue to create value. Yesterday, there was a note that came in that suggested that maybe competitive prices or discounting, the peak of that is behind. And as a result of which, we did see some up moves in the names like Zomato and Swiggy after these stocks had taken a big knock from the top as well. So to discuss trends around this space itself, Karan Taurani of Elara Capital joins in. Karan, a lot has been spoken about, a lot has been written about over the last couple of trading sessions. These stocks have also seen a bit of a decline. From the lows, one, what is your view on these stocks? Secondly, your view specifically on quick commerce profitability. Have your channel checks suggested that the worst of competition is behind?
Hi, Mangalam. Good morning. So I think we largely maintain our view that quick commerce, as a business proposition, is supposed to see very strong growth rates. In terms of competitive intensity, we have got e-commerce players, which have entered this market right now. But quick com and e-com are both very different propositions, as we pointed out in the past as well. I think, in terms of product assortments, in terms of dark store, in terms of economics, the people, the supply chain, the strategy, both are very different things, very dynamic in nature. E-com can enter Q-com, but e-com cannot displace the existing players of Q-com. So I think market leaders like Blinkit will continue to have an edge here. You will see price wars to a certain extent. You will see discounting happening by the likes of Zepto and Instamart. But I think quick commerce as a business proposition is here to stay, and it's quite disruptive for the entire ecosystem. Second part, in terms of the preference in terms of the stocks, Zomato versus Swiggy. What we've seen right now is that, Swiggy valuations have kind of come off by 25-30% over the last 3 to 4 months. And that's primarily been, because of the kind of premium valuations they were trading at. I think the discount for Swiggy versus Zomato even right now is about 60-odd percent, 65% in terms of absolute market cap. And given the kind of scale, Swiggy operates in terms of the food business and the Q-com business, and given the kind of hefty losses Instamart is making today versus Zomato, I think, Swiggy is more of a tactical trade right now. We would probably, bet Swiggy in terms of having an underweight stance over there and maybe allocate 20% of the funds on Swiggy, but still a large chunk of the allocation would come to Zomato because firstly, it's a safer bet. And in these uncertain times, I think you have to play with market leaders. Blinkit has shown top-notch execution in the past with the kind of work they have done in terms of expansion. Even right now, if you see in terms of losses, they are phenomenally low as compared to peers.
All right. Hi, Karan. Good to see you in as always. Karan, so you're saying that the 60% valuation discount will continue to stay for Swiggy versus Zomato. And also you're saying if you're allocating money, 20% as a tactical bet would go towards Swiggy, the remainder will go to Zomato. Is that correct?
Yes. So 20% bet would go to Swiggy, 80% the higher allocation will still be with Zomato. I think the discounts will still remain because in terms of Swiggy, what we've seen, the quick commerce growth rates have actually improved over the last couple of quarters. But, this is coming at the cost of hefty discounts, right? So I think Swiggy, Instamart need to do really well in terms of any kind of a business parameter, kind of reduce the losses from here on to actually showcase a better premium valuation multiple versus Zomato, which is why I think we believe that, just doing a price war, just giving hefty discount is an easier way to gain market share. And I think Blinkit will continue to have an edge here because Blinkit losses are extremely low as compared to what Instamart is reporting today.
Right. So that's as far as quick commerce is concerned. A large part of the SOTP also comes in from the food delivery business for both Zomato as well as Swiggy. And now their growth rates have been slowing down, even though Swiggy on a reported basis was slightly higher than Zomato in the previous quarter. That was also on a lower base. This coincides with quick service restaurants actually seeing a lot better traction with a lot of people, looking at the value offerings that those guys are making. Is there any concern over the growth of food delivery itself? And what's your view on quick commerce, quick service restaurants?
So in terms of the food delivery segment, I think this segment is reasonably penetrated right now. What we are seeing right now in terms of quick commerce, there's ample opportunity to penetrate more in terms of a larger customer base going to non-metro markets. The food business is, kind of matured to a certain extent. So growth rates, I think, will remain in the range of 18-20% in terms of GOV. I think, what has happened that the competitive intensity in the food business is extremely low. I think the players themselves are not trying to focus on user acquisition. and user growth, because they know that there's no large competitor which is going to come in. In fact, we've seen direct ordering platforms make inroads into food business, but they mostly shut down. So I think the focus is, more in terms of profitability, more in terms of margin levers through advertisement revenue, platform revenue. I think margins will continue to see a positive surprise as far as food business is concerned, because it's mature in nature and there's no threat of new entrant as such. And it's a deliberate move, by the companies to focus more on frequency, focus on AOV, and focus on profitability. The second question, what is the second question? You missed the second question.
The second question was, what are your view on quick service restaurants?
So on the QSR piece, I think very clearly what we are seeing right now, the delivery channel is quite encouraging. Delivery-based players are doing well. But even from a dining standpoint, I think the worst seems to be over, because in terms of SSG, we may not see positive SSG in the near term, but I think the SSG is also kind of bottomed out as far as decline is concerned. Second respite is that margins also from here on could not, go below a certain level, because discounting is also come off in the QSR piece. So I think dining will show signs of mild recovery, but delivery-based players, players like pizza category, which have got a high exposure towards delivery, will continue to perform on growth as well.
Okay, very quickly, the SOTP of Zomato, could you tell me what is the valuation you have ascribed to businesses like District and B2B verticals?
So if you look at District and B2B verticals, Hyperpure is about 2.5-3 times CV sales, and the District business is about 2 times CV sales. So if you do the back calculation SOTP, the quick commerce business is available at 2.5-3 times CV sales, which is very, very compelling right now.
All right, we take that point. Thank you so much, Karan, for joining in and giving us an overview on this sector, and we'll keep an eye out on how this progresses from here on. For now, your call is 20% of the capital to be allocated to Swiggy, 80% to Zomato. With that, we'll slip into a short break, and as we do that, some good news for all our viewers. India's business news leader, now just a click away. Shortly, you will get that phone come up where you have the CNBC-TV18 app, which brings you in-depth articles, financial world updates, and all that happens in the markets in real time on your fingertips. All you got to do is download that app from either the Apple Store or the Google Play Store. Scan the QR code which is there for you on the screen. It'll redirect you to the link that takes you to the CNBC TV18 app.